the amount of people that think they own gold versus own the gold, the numbers don't jive.
Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, no amount of alleged conspiratorial refereeing could compensate for the fierce Philadelphia Eagles pass rush. And so the Eagles dominated the Chiefs and won the Super Bowl, and there was great rejoicing and a little rioting in the city of brotherly love. But you shared with the team some foreboding data, David, about what happens when Philadelphia baseball and football teams win titles, the economy loses.
Yeah, it's I can't help it. I do a lot of obscure data, as you guys know, and when I get up at 4 a.m. every day, I start reading stuff. So if we were to conclude the last several times that Philadelphia, whether it was the Athletics, right, way back in the day,
way back when in the early 20th
or the
century,
Eagles were to, or the Phillies for that matter, in baseball were to win championships. So you go all the way back to like 1910, 1911, the Athletics, when it was in Philly, won, and we had a recession. Basically in 1913, we had another recession after they won again. In 1929 and 1930, well, that was the onset, obviously, of the Great Depression. Once again, the Athletics win. Then we moved to it became the Phillies, and in 1980 they won. Good old Tug McGraw and the group, if you remember.
Sure.
Well, U.S. entered a recession, and that was a pretty ugly one. And then the Phillies didn't win again until 2008. Well, that just happens to be the worst year ever for stocks and a pretty deep recession. And then in 2018, the Eagles won. You may remember about 7 years ago. Well, we had a pretty good correction that year. The stocks had their worst year since 2008. And, well, 2025, the Eagles won. So what's going to happen? Well, I don't know. But that is an interesting precedent. So we'll just wait and see. So, but, yeah, wow, what a dominating performance, really, the front four there on the defensive line. Patrick Mahomes looked, he had happy feet. He did not look comfortable that entire game.
I think he was sacked 5 times and was
and
under
no blitzes.
pressure.
That was a record.
No, they just
not
played
a
it
single
with their front
blitz.
four and just kept coming after him. Yeah.
Anyway, it was not an entertaining game from that standpoint.
No.
If you're like me and didn't have a dog in the fight, but I know we have so many fans here locally of the Chiefs, and we have half our employees are major Chiefs fans. But anyway, so they've still got a great team and had a great run. We'll see what happens. And a special little shout out to Cooper DeJean, who basically on his birthday had his first interception in a pick six. What a memorable birthday. And he's from a small town in Iowa, of course, played for the Hawkeyes.
Right.
But anyway, kind of cool to see.
Bringing it back here to home, we will have, we've got our State of the Market address coming up Friday the 21st. David, I'm told the 1 p.m. session is already full. It's maxed out. We have a few seats left for the 10 a.m. session, and you are going to be joined by Jeff Bush. In fact, he's going to join us today in the second segment of the show. Could you just give us a 30-second thumbnail sketch of what's happening?
Yeah, so we're going to talk to Jeff here coming up about what he'll be talking about, but Jeff works for the Washington Update. I know the founder of the Washington Update, Andy Friedman, who have had the pleasure of speaking with many times and sit in some of his keynotes. Basically, they are a nonpartisan kind of think tank, if you will, that prescription-based. They consult Wall Street firms like ours on kind of what the political landscape looks like. So he's going to talk about where we are with the current election, what the reality of maybe campaign promises to what really gets instituted, how those processes work, and then kind of what he thinks is the opportunities that he sees before us. And what's unique about Jeff, though, is not only he's been doing this for a long time, he actually worked at a very high level at 2 national firms. We won't give out their names today, but prominent firms that are nationally known. He was very, very high up in those organizations, so he understands the financial services business extremely well as well.
Well, we look forward to hearing from him in the second segment of today's show. Well, David, I was driving in here this morning to record the show, and the news was crackling with the CPI. And here's a headline from Investors Business Daily. CPI inflation too hot. Even before Trump tariffs, S&P futures tumble. What's going on with CPI, David?
Well, ironically,
the Consumer Price Index, of course.
If you remember right on this show, I said a couple weeks ago, we're going to see CPI hit 3% or slightly over it. My prediction was actually 3.04, and I think it was 3.03. They round down, so they report 3.00. Well, Wall Street was expecting 2.9. And year-over-year inflation, core inflation, was actually almost 0.2 hot at 3.3%. So Inflation is now back above 3% officially, first time. So you got to go all the way back to last June, Chip. Well, I thought we had squashed inflation, right? And that does not seem to be the case. And if people and economists want to believe that some of these tariffs will be inflationary, what does that bode for the future? Well, if you were to Mohammed El-Iran, who we've quote many times on the show, he was actually this morning on one of the news shows, and he was talking about if the Fed was serious, you'd be seeing a rate hike immediately here, literally. But, of course, they're just going to say, hey, we're just going to pause for longer, which was the message they gave earlier in the week, and that's probably likely. And now the futures market has priced out the likelihood that we get a Fed cut at all this year. So, that means higher rates. That's not good news for the housing market. As we've seen, mortgage rates are still hovering up there close to 7%. But anyway, all this is not great data. And then we had a jobs report come out that reported, hey, unemployment's down to 4%. That's weird, Chip, because they only added 143,000 jobs when we were expecting 260,000
I think 169,000.
jobs.
Yeah.
And so that was a pretty big miss. And yet participation rate went down. So therefore unemployment went down. Again, do you believe the numbers? Can you trust the numbers like we used to in the old days? People are questioning that now, but it doesn't feel like a rosy job number. It sure doesn't feel like 4% unemployment out there, and we have job cuts being announced every day from major employers across the country still.
Well, and before we leave the CPI, I just want to get your take on this. David Russell, a Wall Street analyst, says time could be running out for this bull market if we don't see progress on inflation soon. Yes,
yeah, and so, that's absolutely. We've talked about this. I think the best case scenario is we can trade in a range here. On the S&P, that would be likely 5,800 on the low side of the range to the top side around 6,100, give or take. And, that's a 4 or 5% range that the market could just kind of wade back and forth over the next 4 to 7 months or so, where it gave the economy a chance to catch up, the company's earnings to catch up. But if the earnings slip, if inflation is eroding their profits, and that's what inflation does, and it erodes your spending power, therefore you can buy or consume less of those products, then the earnings would have to be revised significantly lower. And if that happens, stocks typically follow. So the likelihood of the market, falling significantly lower is getting higher by the day. Now, we don't know when. We're not trying to prognosticate or predict that, but we want people to be prepared. Do you understand what it means if we were to? So if we break out of that range, like 5,800 or so on the S&P, you could quickly be down around 5,300 to 5,400 in a blink of an eye. 2-3 trading days, that could literally happen because these technical levels are very real by big institutions. And when they breach, they hit the sell button. They don't ask questions. And so just be prepared for some increased volatility this year.
Tariffs, David. President Trump's tariffs or proposed tariffs have been making a lot of news. I want to throw 2 headlines at you and get your take. One is from Fox Business. Trump tariffs could impact biggest U.S. meat producer. That's Tyson. And then locally, the Omaha World Herald ran a story, why Donald Trump's tariffs could affect Nebraska exponentially more than other U.S. states. And it quotes Ernie Goss and other local economic officials. People in the ag sector do get nervous, David, about talk of tariffs and trade wars because, for instance, our beef, our soybeans, our corn, our exports in Nebraska, tremendously dependent on foreign markets.
Yeah, and we sell the majority, over 80% of Nebraska corn is sold in Mexico, I believe. It's a very large portion.
Well,
in fact, we built rail car. We've got a railway that literally was built to move the corn south.
Well, that's what
right?
a guy quoted from the Farm Bureau in the story in the World Herald says, the railroad system is built to get corn to Mexico. It's our closest and most efficient trading partner. And in the Tyson story, the guy said, well, maybe these tariffs won't actually happen or won't be as severe as initially proposed, at least with Canada and Mexico. And or he said, we got to find some new markets. It is a big world out there. But
absolutely is. And I would tell you this, though. If you don't study history, you're doomed to not learn from it or repeat it, right? The one thing we know from Trump is he doesn't start soft in negotiations. All you have to do is read his original first book way back in the 80s, The Art of the Deal. His negotiating tactic is to swing big and hard first, and then if you submit, he will then back off to get the deal done if it's a win-win situation. And we've already seen this with Mexico, with Canada, just in this most recent round, and to some extent with China. And so, I mean, I would just point out, not just on the agricultural side, this is certainly of concern for our local growers and folks that raise cattle, et cetera. But the aluminum and steel tariffs, right, that just kind of
Yes.
are going to be enacted now and were announced. Well, just so you understand, China is importing 60% of their steel into Canada and then dumping it in the U.S. because it's cheaper than if they send it direct. Again, there's always workarounds, right? So China simply goes to Canada, and that's the reason for that tariff to punish China, not necessarily Canada. But again, if people do what is asked on the other side, you usually see him give in or give some concessions back. It's just his style. And it's worked thus far. You would have to give him credit. So again, while you get scared of it, the idea though is, listen, if we don't put tariffs, we fight inflation, right? Because if inflation gets out of control and we can't get our prices aligned, then that's a hidden tax on the American consumer. And we lose jobs because somebody is making an inferior product and dumping it in our market cheaper than we're manufacturing it here. So again, do you care about buying American? I do. Not everybody does. I get that. But sometimes you're going to pay more to buy a product made here. Now, what's changed let's face it, you go all the way back in the 1800s, we've had tariffs, and certain goods were very expensive to ship across the Atlantic Ocean. It was a 4 or 5 day journey, even when we had powered boats, right? It was weeks when it was just sails. But now you can ship products efficiently, quickly, et cetera. And on speaking of the shipping, right? What did we build? What did we spend a ton of money, a lot of lives lost building an infrastructure wonder of the world?
Panama Canal.
Yeah, absolutely, the Panama Canal. And then we basically turned it over to Panama with the idea so that they could liberate their own economy and they could make the fees. And they turned around and just kind of handed it to China in terrible decision making. So he said no. And by the way, if you go on Google Maps or something now, you'll notice there's a body of water that officially has changed its name. So he's putting his stamp on for sure this time, Trump 2.0. But I wouldn't get too overly worried about these tariffs just based on his historical precedent of how he kind of swings the big hammer and then backs off and shakes somebody's hand and gets a deal done.
Relax, Tyson. He's just playing chicken. Sorry, I went there. I couldn't help it. Up next, he's a nationally recognized authority on business and financial issues. He's coming to Omaha to participate in our annual State of the Market address, and he joins us next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. From Wall Street to Main Street, the Washington Update is recognized as one of the most reliable sources of information on business and financial issues. The author of the Washington Update will join David Brooks for our February 21st State of the Market address, and he joins us now for a preview of what he will share later this week. David, please welcome our special guest, Jeff Bush.
Hey, Jeff, it's great to have you on the air with us. Everybody, we're talking again with Jeff Bush from the Washington Update, who is going to be our featured keynote at our State of the Markets update here coming up this coming Friday. So, Jeff, hey, thank you for taking a few minutes to jump on the radio show with us this morning.
Well, I appreciate the opportunity, David, and I appreciate the opportunity to speak with your clients and on Friday.
Well, your partner in crime, Andy Friedman, I've got the pleasure of seeing him speak many times. And tell everybody a little about the Washington Update and kind of what you guys do. You guys are basically kind of nonpartisan, and you, of course, worked in my space for many years in the financial service industry, but you kind of help decipher what's really happening in D.C. at different points in history. And right now, it's a lot of action going on there. So what are you going to tell us?
Well, my goodness, considering we're still a few days away from the event, it's not exactly clear what we'll be talking about at the recent pace of things in Washington. But I fully anticipate covering the power dynamic in Washington, D.C., how that's changed post-election. Obviously, it's a little bit unique in a Trump 2.0 type of tenure. But then we're also going to talk about fiscal policy and the fiscal reality our country is facing. I still hear a tremendous amount of confusion from people when we start talking about debt and deficit and spending and tax policy and the like. So we're going to go through all that. And more importantly, for attendees, we're also going to talk about what direction tax reform is heading and opportunities they can take advantage of the tax code today and what we think the tax code's going to look like starting in tax year 2026.
Well, I think that's really important. Obviously, we have some changes, at least on the books today, that would go in place. And, you and I were able to talk not that long ago, but I think we agree that there are going to be several things that are extended, but maybe not quite all the things that are being touted would probably get enacted. There's campaign promises, and then there's reality, right?
Absolutely true. The one good thing about Trump, not only thing, but one good thing about Donald Trump is generally what he campaigned on, he actually tries to get done. And that's a little surprising coming from a politician, but it does give us a good roadmap to follow in suggesting what direction tax reform will likely head. But interestingly, in 2025, it's not just tax reform. We've got a tax reform effort on top of two budget debates, one with a deadline of March 14th and one of September 30th, on top of a debt ceiling issue. As we know, we hit the debt ceiling back in January, and that needs to be addressed as well. So I'm kind of calling it the perfect fiscal policy storm of 2025.
Do you think, speaking of a fiscal storm, right? I think we need to all realize that we want a responsible government. We may not always all agree on what we spend money on, but if we just had a budget and we reported actually, hey, here's our budget and here's how much we went over in each department, do you think we're really going to get that level of transparency out of this new administration?
Generally not, no. And what we've seen so far are those headline issues around USAID and other types of things. So you're right. When you get into the granularity of the budget, it gets lost in the details. We will get those top line numbers. We will have the Republicans agreeing on a net cost number of their tax reform and budget effort. We should actually get that relatively soon if they're on track to get something done here in the next few months. That's where I am a little bit hesitant to think that we're actually going to get something done that quickly. And my gut tells me the Senate's two-step process is probably more likely, which means we won't get that granularity on the tax reform until probably, certainly late summer, if not early fall.
Yeah, and that's what I think is realistic. Is a lot of people hope that things would get rammed through, and I'm like, that's just not how the process really works in the real political system. So, if it were the earliest you'd get votes could be maybe say the end of April, early May, but that reality is probably we're looking at the fall before anything really gets done, right? So that makes it a challenge, and I'm excited to have you come out and just talk about some of the pending changes and what that looks like. Obviously, we won't know exactly what it's going to look like, but the estate tax is a major issue for many of our clients. We have a very big exemption number today, but what are your thoughts on what reality will look like here in the near future? Not only just with what maybe this administration gets through, but if we just were to go out to the next election, 4 years out, presidential election, and how quickly things could change in a different direction, and why people should maybe be very proactive. I think in 2025 is kind of my theme on the estate planning. Kind of want to know your thoughts on that.
Oh, I completely agree. We have a very generous estate tax code right now, and I'm encouraging audiences to take every advantage of that while we know what the code is, because as early as January 1st, 2026, it may be completely different, especially if you're in a situation that you have illiquid net worth, for example, land or something like that. That makes it even more imperative that you take advantage of this very generous code.
Well, I tell you, you're speaking our language out here with that, because so many people here have family farmland that's third, fourth, fifth generation, and the asset level, the prices of these assets have just continued to go up in valuation. But as you mentioned, they're illiquid assets. They don't produce much as far as cash flow, and people have no understanding, at least the majority of them, of what's going to happen if those levels drop like they're scheduled to, and someone were to pass away and no planning was done, right? These taxes, state taxes federally, and out here in Nebraska, we're one of 6 states that still charges an inheritance tax, which is ridiculous, but we do it, and so without planning, people can find themselves in pretty bad straits.
Well, and that brings up a great point. The states may look at this as an opportunity to reform their tax code as well. Obviously, we have no transparency into that at this point, but it certainly is an issue. My family had a century farm, and it was a tremendous struggle to keep that going through the generations because of the illiquid nature of that asset. And thankfully, we've been able to keep it together, but it's a tremendous it's something you have to be very proactive in, without a doubt.
Well, I love that you're talking about maybe the states could use this idea. Hello, Nebraska legislature, if you're listening, to be proactive in changing our own reform, because all of our neighbors have more proactive and better tax systems than we do, and we lose population to it. But listen, hey, just got a couple minutes left, Jeff. I just want to shift gears real quick to the confirmation process going on now, and what is your opinion of how fast or how slow they seem to be going? It seems when the previous administration got in there, even though I may not have liked the nominees, the Republicans kind of voted and put people forth that the other administration admitted. We seem to have a little bit more infighting even within the party of the current president on these confirmations. Are these controversial folks like Tulsi Gabbard and RFK Jr., et cetera, are they going to get through, or what do you think?
Yeah, they had their hearings last week, and I have every expectation that they'll get through at this point. Donald Trump has put forward some people with some varied backgrounds, to put it mildly, and the Republicans felt the need to vet that and fulfill their responsibility on advice and guidance to the president, and advice and consent. But as I predicted all along, he will get the mass majority of his people through. And in this case, it appears that Matt Gaetz may be the only sacrificial lamb, if you will, in his offering.
Very good. Well, hey, listen, Jeff, we're out of time this morning. I'm really excited to have you out here coming up this next Friday, February 21st. For those of you listening, we still have just a handful of seats available for the 10 a.m. Showing, if you will, where you'll get to hear from Jeff and myself on kind of the state of the market, the economy, and a lot of legislative issues and what we can expect going forward. Again, but you have to register. You need to call us at 402-369-7777 or go to retiresmartnow.com and register. That'll be 10 a.m. at the Durham Museum, but you must register. Jeff, thank you so much for your time, and hopefully you have safe travels out here. Pack a coat. It's a little chilly.
I will pack a coat. Thank you, David.
All right, Jeff, thanks for being on.
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go, David. First question is about 401k savings. I have about $700,000 saved in 401ks from several employers, past and present. I'm 55 and probably will work another 10 years. Am I in good shape? Do you have any recommendations?
So at 55, $750,000 is actually slightly better than the average saver in America. So you're doing okay. I'd say you're doing fine. Now, is that going to be enough? And in 10 years, the answer is if you continue to save and you get just traditional market growth, you probably will have about double that sum by the time that 10 years gets here. So are you in good shape or not? How much income do you plan on spending in retirement? There's a lot of questions here to tell you if you're really in good shape. However, what I would tell you is just a word of caution is, if they're old 401ks, you're probably not getting any active management, and unfortunately, you probably don't have a lot of choices within the 401k plans. Most of these are just cluttered with a bunch of what we call target date funds, and so there's not a lot of choices. And if you've used those in the last few years, you've probably underperformed the market significantly, because the older you are, the more conservative the fund says it's going to be. So if you said, hey, I'm going to retire in 10 years, you're going to buy basically the 2035 fund. Well, that fund today probably going to have 50 to 55% bonds in it, and bonds have been being crushed with interest rates going up these last few years. So that's not always the best methodology. So one, you have some choices available, and it wouldn't necessarily have to be our firm, but we're happy to engage you and discuss what it looks like. But you should sit down, in my opinion, with a good professional who understands your situation and look at the options of rolling your old 401ks over into an IRA, whether you choose to manage it yourself or hire a professional like us, because now the world's your oyster. You can invest in anything. You could also go de-risk your portfolio if that's something that concerns you, or you could seek out active management to try and outperform what you're trying to do. There's a myriad of options. You could also start to diversify into multiple asset classes, commodities, real estate, all those things that we think are a true holistic diversified portfolio. So a lot of options. You may also start doing some tax planning if you did that, where you probably can't do that in the 401k.
Yeah. Are those traditional accounts or Roth accounts he's talking about? Because if they're traditional, then you got the whole tax.
He could be taking advantage of the
implication.
tax rates today and potentially move those to tax-free IRA or Roth IRAs.
Otherwise, that $1.5 million, I mean, as you say, if everything goes well in 10 years, may have $1.5 million bucks, but
It's not really yours.
Yeah. How much of it's going to Uncle Sam? Have you figured in medical and health expenses and so? Well, the whole smart planning process that we do.
Well, one of the unique things is people do like to take risk off the table. I actually sat with a lady yesterday, the very situation, had about 1.3 million saved for retirement, planning on retiring in just a couple of years, and was like, I just don't feel like I want to take a lot of risk. And so some of the things we encourage people, if we were to roll those over and de-risk your portfolio, and we could talk about how we do that. But if you're still going to work for the next 10 years, we'd want you to be actually really aggressive with your current 401k, because all the balances have been rolled out. You're starting basically at a very low or no balance, so you can afford to be pretty aggressive. Even if the market were to get kind of squirrely, you're just going to be buying more shares of everything, and you're going to get a better long-term rate of return. Again, needing people to understand risk reward, how to set the appropriate balance for where you are, what your expectations are, but that's what sitting down with a qualified professional can help you do. And again, we have what we call the SMART plan, which will look at all 5 areas, not just the investments.
Next question, David, is about a trust. My husband died last month. We drew up a trust about 10 years ago. Do I need to make any changes to the trust now that my husband is gone?
The answer there is going to be most certainly yes. Now, I'm not an attorney. I certainly don't practice law. We work hand in hand with qualified estate planning attorneys and senior elder attorneys to make sure all your documentation is the way we think it should be. So typically when we have trusts that are joint, right, and so your husband has passed, and if it was a joint trust, you're the surviving trustee. So we have basically beneficiaries of a trust, and we have the trustee of the trust. So most revocable trust, which is what I'm going to assume this is in this situation, it could be one and the same, where I am the trustee of my trust. I tell my trust what to do, but I'm also the beneficiary, right? It acts on my behalf and eventually on my beneficiary's behalf. Where you may want to change that now as you're single, you almost certainly are going to want to change the language in that trust. You could create a new trust, and then it just depends. Do you want these assets to pass to your children? Are there specific things you're trying to do? How many assets are in the trust? I mean, there's a myriad of questions, and we often have Colin Kastrick, who is an estate planning attorney, specifically on this show often. I would highly encourage you to attend the class we call Tax and Estate Planning, where they go over all the basics of trust work that's included in that class, and this would be an appropriate reason to go to that class.
All right. If you want to make sure that your loved ones and your favorite causes are taken care of when you're gone, take advantage of that opportunity, estate and tax planning. We'll have another one coming up soon. David, back to the 401k world. This question is about 401k options. My employer offers a 4% match for contributions to a traditional 401k account. But my employer also offers a Roth 401k option. I've heard you talk about the benefit of tax-free growth and withdrawals from a Roth account, but I hate to leave that employer match money unclaimed. Can I contribute to both 401ks, or do I have to choose?
Okay, a lot in this question. So first off, the 4% match is most common today because that makes that 401k for the business ownership. That they're putting out what's called a safe harbor 401k. And by guaranteeing a 4% match, if you contribute, again, this is a defined contribution account. If you contribute, your employer will contribute. But if you don't contribute, they don't have to contribute on your behalf. However, when they guarantee that percentage at 4%, they're locking in what's called the safe harbor rule, which means they can fully fund their retirement plans, max it out, even if their employees choose not to put it in there. So it avoids what we call testing. And so it allows the owner to make sure he's going to take advantage of it. Now, I've got great news for you. Most 401k, now your plan documents will lay this out, but most 401ks, and just so you know, the 401k we provide here at Retire Smart is similar. We offer a 4% match for our employees, but the employees don't have to put any money in the traditional side to get that match. They may put it all in the 401k side. We will still match their salary deferral, whichever side it goes in. However, our portion is going to go in the traditional side. And so, because otherwise we would have to pay tax on those dollars. So the employer side typically is going to go in the traditional. Some plans do require you to put at least that part. Like you need to get your plan documents or talk with HR. But if that's required, then put 4%. Let's say you were going to put 15% of your income into your 401k, put 4% in the traditional side, and then put 11% in the Roth side. If they allow you to put it all on the Roth, then put it on the Roth. Personally, that's what I do. I match my own 4%, right? My 4% match goes in the traditional side, but I max fund my Roth account. So does my wife. So does my son who works here. And,
I max out my Roth too.
And Chip, you get to go even higher this year. We have the old man catch-up contribution became available for the first time in 2025. So you get to actually put more than I do, at least for the next 3 years.
Yeah.
So yeah, and you max that out, and so I mean, basically, you could put over if you're of age, you can stick over $30,000 now into these accounts, and putting that into a tax-free account is extremely a good idea because that money starts to compound and grow. And if you're going to max these accounts out on the tax-free side, if someone did that just for 10 years, I mean, they're going to end up with a nice chunk of money that is 100% tax-free. And to your point earlier, we talked about, hey, if you've got 1.5 million on the traditional side, or you end up with $1 million in the tax-free side, which account do you want?
I'll take the $1 million tax-free. Thank you very much.
It's actually going to end up with more. You're going to end up with more net spendable money, and so that is what people need to understand: is you have a silent partner in your accounts, your retirement accounts. It's called the IRS, and sometimes it's better to buy that partner out before you grow the business, so to speak, or grow the account value. Which is one of the things we can help you understand with our report card, so you would understand: hey, should I be using the Roth side? Should I use the traditional side? Should I be thinking about conversions? All that can be answered with our report card that we offer complimentary to our listeners.
Well, so the answer here is yes, you can contribute to both a traditional and Roth 401k if your employer offers both. Are there any scenarios in which you cannot contribute to both?
You're capped at the dollar amount, right? So
Okay.
27,000 at age 30, et cetera. So you're capped by your age, 23,500 for those under 50. So whatever combination you want to put that 23,500 away, traditional and Roth. But once you put 23.5 in, you can't put any more unless you're over 50. Then you get the $7,000 catch up, and then if you're old like Chip, you get even more.
Had to throw that in there. Huh?
I don't know, just can't help it.
Up next, Walmart and Costco are doing well. What does that tell us? We'll explore that next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. David, you sent the team a chart, and wow, it shows Walmart trading at 37 times earnings, Costco 52 times earnings. We expect this from the Magnificent Seven, the tech companies. This is old-fashioned retail. What's going on here?
Yeah, and you're seeing this. We have on the screen for those watching on YouTube a chart of Walmart, and the last year that parabolic straight up is basically 2024, right? That is not typical to see a behemoth in the retail industry to trade like this. That would look like a tech stock, right? And so what's going on? Why are we willing to give this high valuation to traditional retail companies that usually trade at much lower multiples, right? So right now they're trading, as you said, respectively, Walmart was trading at 32 times earnings and Costco 52 times earnings. Something has to correct. And if you're looking at the graph there, we have something called relative strength indicator on that chart. You see the big flashing red at the very top of the peak. That's telling you how long it's been overbought. And so these things typically correct. Everything reverts to the mean. And so I always point that out. So are we in for a correction? Highly likely. Again, things can go on for a ways before they do correct. But, we've seen this in the last year. We saw this with MicroStrategy, with Super Micro. Some of these stocks we talked about went parabolic, and they almost always correct, and we're seeing that now. So I believe this is a cautionary tale telling you that while the market did broaden out a little bit last year, not just the Mag 7, you saw some other stocks, is it really sound principle to invest in these companies at such high multiples? And the reason they did that, Chip, is the idea that last year, remember at the start of last year, hey, we're going to have 7 rate cuts. Wall Street told everybody. And by the way, at our State of the Market, I told you that was not going to be true, right? And of course, it did not come to fruition. So, and here we are now, probably having 0 rate cuts this year. So if that's the case, then we're going to have to readjust earnings, which means we're going to have to readjust the multiples we pay, and these companies will most likely have to get repriced. And again, I can't guarantee what's going to happen, but again, it's a word of caution that if stocks like Walmart are going parabolic, we may be near the end of this current bull market. We don't know.
Well, you're calling that a cautionary tale, David. And then speaking of cautionary tale, you also shared with the team some information. Kyle Bass is someone, you referred to him as the guy they left on the cutting room floor from the movie The Big Short. That, of course, was about the 2008 collapse in the real estate market that then generated the financial catastrophe that
and
led
Kyle
to the
became
Great
a
Recession.
multi-billionaire during that period.
Well, first, so tell us, who is Kyle Bass? Because you follow him.
I do. He's a great patriot, but he runs a company called Heyman Capital. They're based in Dallas or in Texas, outside of Dallas. But he's got a whole book on him. So Michael Lewis, who wrote the Big Short, it became the movie, and he wrote like The Blind Side. Many of his books have been turned into movies. Very well-known author. He thought that Kyle was literally almost like cuckoo, right, when he interviewed him. So they decided not to put him in his part in the movie when they did all the research that kind of left him literally on the cutting floor. They'd have an actor slated to play him, but they decided not to even feature him. After everything unfolded in 2010, Michael Lewis wrote a whole book called Boomerang on Kyle Bass. He was the most accurate of all the ones. He wasn't even in the movie. And I mean, one of Kyle's biggest decisions is he bought nickels. He has warehouses of, literally hundreds of millions of dollars of nickels now in his possession. And we got another story we're going to talk about later. And the reason he bought the nickel.
Nickel may be a factor.
A nickel is worth 9.4 cents, right? Because of the silver in the nickel. It's worth more than a nickel itself.
Yeah.
And so I know we're going to talk about another one of our coins here in a few minutes. But the point is, Kyle is a brilliant guy who kind of sees at the macro level what's going on. He's a huge advocate for the United States to be weary of China, where he's been many times and had a lot of investments over the past. But he's pointing out some unique things in the gold market right now.
Well, he told the University of Texas, you better move your gold holdings here in state. In fact, the state of Texas set up a bullion deposit or something.
Yeah.
Right?
So if you've ever seen the Die Hard series of movies, so Die Hard's a Christmas movie, even though we're in February. Let's cover that. It's Valentine's week, right? But if you saw the third rendition of that, right? Jeremy Irons was the villain, who was Hans Gruber and the original villain's brother.
Okay.
And basically had these bombs in schools in New York City, but it really was a ruse. What did they rob? The Federal Reserve in New York, where all the gold is allegedly stored, right? And there is gold there, but not all of it. But anyway, we can talk about where the gold really is. Is it in Fort Knox? I don't think so. But anyway, so he literally told them, listen, the amount of people that think they own gold versus own the gold, the numbers don't jive. And so he literally told the university, he donates heavily to the University of Texas, hey, and he sits on their board as an investment committee, you need to go get your gold and just physically take delivery and bring it. And they did. The University of Texas built their own depository.
Musical chairs. Hey, there are 20 people, but only 10 chairs.
So you need to understand is there are, and we invest in gold via exchange traded funds for our clients a lot to get them exposure to the upside. Now, we also help clients, if they want, show them how to go buy physical gold. Now, we don't want to do that in your IRAs. We talk about the dangers of that. But if you want to go buy it, we have places locally we recommend people go look to have. I have physical gold and physical silver. I own it. It's in my hand or in my safe, right? I can touch it, feel it. But there are certain ETFs that simply are tracking the price of gold that don't own the gold. So, and there's multitude of these ETFs out there. You want to make sure the one you own is legit and can actually produce it. And the reason is right now in London, there are people coming for physical delivery and they're telling people, it'll be 6 weeks before we can deliver it. And people are speculating, well, I don't think they have any left. I think they're out of gold. I think they ran out of their deposits and they don't want to let anybody know.
Here's what I can't figure out. I'm thinking of the Bailey Savings and Loan, and It's a Wonderful Life. That I understand financial institutions, they make loans to people. They don't keep every single dollar, every single penny,
and that's
right
the difference
there on
here, because that's fiat currency, and exactly when you make a deposit.
But with gold, it's a different ballgame, or
correct.
It's supposed to be.
It's supposed to be a different ball. You are correct. So in other words, if they've lent it out, do they have the right to go collect it back? Is it collateral, or are they fibbing and they're telling you no, it's down there 7 floors below
in a vault,
in a vault down below 700 feet below ground, etc. Or are they lying? And so there's speculation. And we've seen a parabolic move. Now, I'm not telling you to go out and rush and buy gold and chase it. I do believe gold going higher. I will tell you that. But again, you need to understand risk versus reward here. If you're in your retirement, you certainly should have exposure to these things, but you need to have it in a appropriate portion. And the other thing is gold is over 90 to 1 right now, gold to silver prices, Chip. That's an extreme, and it happens. Gold goes up first typically when gold does make these runs, and then silver catches up. So if you're out there and wanted to play a little speculation play, you might want to buy silver here because silver has not made its big parabolic move yet. And if it caught up to a more traditional 50 to 1 ratio, there could be some money to be made there. Again, that's speculative capital only. You would do that, but
So is there a Bond villain out there somewhere hoarding gold, or
Well,
what? How is this shortage happening?
What's happening is, yes, you're seeing sovereign nations buy the physical gold. The retail investors have not been buying physical gold that much. In fact, it's down. It's sovereign nations that are taking physical delivery, just like Texas wants to protect its state sovereignty. It just let's go ahead and bring that gold down here, and they did that. And I would recommend all states should have a small reserve of this and should have their own depository. I think that was brilliant for Texas to set up such an institution, because now if states claim it, why would they do that, Chip? Well, if they believe the debt of the world is due to get repriced. In other words, what happens when a country overspends, right? They have to finally declare bankruptcy, and we've seen many nations default on their debt. We reprice the value of their debt. So if you have hard assets, it goes up in value against the currency that got crushed because of that devaluation, right? So if the dollar, which some people have been crying forever, the dollar's going to go down in value, which has gone up the last several years. If the dollar were to devalue by 20%, your gold in the terms of dollar prices would go up 20%. Does that make sense? It's a hard asset, and it's a great inflationary hedge. But again, should not be the only asset someone holds, but it's something to keep an eye on here for sure.
David, let's squeeze this one in the time we have left this week. So ABC News ran this headline: Trump's order to scrap the penny doesn't make sense. C-E-N-T-S, sense. And it quotes Mark Weller, who's the executive director of Americans for Common Sense, C-E-N-T-S, a Washington, D.C. organization that provides research to Congress and the executive branch on the benefits of the penny. Who knew that this existed? He says it's a horrible idea to eliminate the penny. Well, actually, he says we're going to lose money on it because people say, well, it takes, I think, 3.9 cents or something
it takes 4 pennies to make a penny, right? Yeah.
But it takes 14 cents to make a nickel. We were talking about nickels just a moment ago. It takes 14 cents to make one nickel. So, and the nickel will now, all prices will be rounded up or down to the nearest nickel. And on that point, he also says inflation, it's going to feed inflation because everybody will round up to the next nickel. Are his concerns well-founded?
Well, and there's case study. Actually, Canada basically got rid of their version of the penny, and they did all the prices rounded up to the next nickel. So it did create an inflation riff of about 2.5% additional inflation for a couple of years when they went through that transformation. But should we continue to mint pennies that cost us 4 cents, or maybe should we keep the penny in circulation? Right? Is there a hybrid answer here? And that's my philosophy: is let's keep the penny in circulation as valuable, but maybe not print as many. Right? Because
actually, your point is well taken. Trump said stop minting the penny. He didn't say it's
we don't want to wipe
it
out. So penny's still part of it. And let's face it, 92% of all transactions in America are digital. So we can keep the penny, but we just don't need to mint anymore because not as many are moving around. And again, I love physical money. I think you should teach your kids how to pay and get change and count change. I mean, if you want to have some fun and if you got time on your hands, stop by like a Burger King, get a cup of coffee, and then if they tell you it's a $2.37, give the teller a 20, and then give them like 7 cents and see if they figure out what you're trying to do to make their life simpler, right?
You are that guy, aren't you?
I just for 10 minutes, you just want to watch them kind of freak out.
Oh, my goodness. Speaking of freaking out, I have hosted local Tea Party rallies, and I didn't know, but Caroline Turco, who's with the American Numismatic Association, numismatics currency, she told ABC News that technically, we've never had a penny in the United States. The American system does not have a penny. That is a misnomer, she said. We have a cent because we rebelled against the British, and they had pennies. That is a British word. Oh, my goodness.
Well, in the British, it's pence, not pennies, right?
Yeah.
So 100 pence makes a pound.
Yeah.
But ironically, they don't call it a pound. They call it a quid, right? Hey,
Yeah.
how much for lunch? 7 quid. Wait, quid? What?
You lived over there for a while.
Yeah, I
so
did.
You know,
I spent a lot of time in London. But anyway, it is kind of fun to watch what's going on here. I'm excited for this year to see how things unfold with this current administration. We're going to be talking a lot about this at our upcoming State of the Markets. Again, we have limited seats, so if you would like to attend, you need to give us a call now.
That'll do it for this week, folks. Please visit our website, retiresmartnow.com, and click Attend an Event at the top of the page to see everything we currently offer, including that State of the Market address. There's no charges, no obligation for our events, but you need to register. You can do it online or by calling 402-369-7777. David, bring us home.
Hey, have a blessed and prosperous week. Hopefully you stayed warm.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week. Washington Update author Jeff Bush is not a client and was not compensated for his appearance on this show or any apparent endorsement that it might imply. However, Jeff Bush is being compensated for his upcoming speaking engagement sponsored by Retire Smart.